What if I told you that inflation isn't just about rising prices, but about money itself? In fact, inflation is always and everywhere a monetary phenomenon. This means that, at its core, inflation happens when the amount of money in the economy grows faster than the goods and services available. Prices may rise for many reasons, but for inflation to persist over time, there has to be too much money chasing too few goods. Let's take a simplified analogy to demonstrate the concept. Imagine you live in a small island economy with only 10 coconuts and $10 in circulation. If each coconut costs $1, everything is balanced. But if the amount of money in circulation suddenly doubles to $20, while the number of coconuts stays the same, what happens? Well, prices would also have to double. The real value of each dollar falls, and it takes more money to buy the same goods. This is inflation in its purest form. Now, many economists talk about demand pull and cost push inflation, the idea that prices rise because of increased demand or higher production costs. While these are real forces in the economy, they don't actually cause sustained inflation unless they are accompanied by an increase in the money supply. If demand rises for a product, but there's no extra money available, people will simply have to cut spending elsewhere, and prices in other parts of the economy will adjust. The same applies to cost-push inflation. If energy prices rise and businesses have to pay more for transport and production, they will try to pass on costs to consumers. But if there's no extra money circulating, overall inflation remains limited because consumers will reduce spending on other things. This is why demand and supply pressures matter, but they don't drive long-term inflation on their own. That's why central banks monitor these factors closely, but they look at monetary expansion as the key driver of inflation over time. So is inflation good or bad? The answer depends on how much inflation we're talking about. A small, steady rate of inflation, around 2% per year, is generally seen as beneficial. It encourages people and businesses to spend and invest rather than hoard cash, which keeps the economy moving. It also allows wages to adjust gradually, making labor markets more flexible. And crucially, moderate inflation helps prevent deflation, where prices fall over time. Deflation might sound good at first, but in reality, it causes serious economic problems. If people expect prices to keep dropping, they delay spending, businesses make less money, and workers face wage cuts or job losses. That's why central banks deliberately aim for a little inflation, but not too much. When inflation rises too fast, the situation flips. The biggest problem is that inflation erodes purchasing power, meaning your money buys less over time. This hits the poor the hardest because they spend most of their income on necessities like food, rent, and transport. Unlike wealthier individuals, who might own assets that rise in value with inflation, like property or stocks, the poor have few ways to protect themselves. If wages don't keep up, even basic goods become unaffordable. Beyond that, high inflation distorts the entire price system, which is the backbone of a functioning economy. In a market economy, prices act as signals. They tell businesses where to invest, they help consumers decide what to buy, and they allow workers to judge fair wages. But when inflation runs too high, these signals get scrambled. Imagine trying to navigate a road where the speed limit signs change every hour. That's what happens when inflation is unpredictable. Businesses struggle to plan, workers don't know if their salaries are keeping up, and long-term investment dries up because no one can accurately forecast future costs. If inflation gets completely out of control, the economy can break down entirely. In Weimar Germany in the 1920s, prices rose so quickly that restaurant menus had to be updated several times a day. In Zimbabwe in the 2000s, workers were let out of their offices early, not as a perk, but because they needed to spend their wages immediately before they lost value by the evening. Hyperinflation also destroys savings, wipes out pensions, and forces people to barter or use alternative currencies just to survive. Even in more stable economies, inflation can have bizarre effects on everyday life. Have you noticed that chocolate bars seem to be getting smaller while prices stay the same? That's shrinkflation. Companies reducing the size of products instead of raising prices outright. A Mars bar today is noticeably smaller than one from 20 years ago. It's the same effect as a price increase, but disguised. That's why governments and central banks work hard to strike the right balance. Enough inflation to keep the economy moving, but not so much that it distorts markets or erodes trust in money. But how exactly do central banks control inflation? The answer lies in interest rates. Click here for the next video, where we'll explain how central banks use interest rates to keep inflation in check. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.